Jim Rickards, or James G. Rickards, is known for being an investment banker and a media commentator, which means that you've probably heard from him about his comments and thoughts on the world's financial situation. Like all other famous finance gurus, he believes that there will come a time when each one of us will experience downfall in our finances. What is he talking about, and does his opinion matter? Well, you better listen attentively as he warns us about the catastrophic recession. Welcome to Nova Society, paving the way for your financial success. If you're not subscribed yet, become a member of our community. For Jim Rickards, it seems that the world has been experiencing an economic downturn since 2007, and he believes this situation will persist for an uncertain period. When people react by saying, "Hold on a moment," they usually refer to the technical definition of a recession, which involves 2 consecutive quarters of reduced GDP and an increase in unemployment, along with a few other factors. There's also a certain level of subjectivity involved. The National Bureau of Economic Research serves as the unofficial but widely followed authority to determine whether we're in a recession or not. So, the question arises, how can we label this as a depression if we're currently in the 10th year of an expansion? The answer lies in the fact that many individuals misunderstand the actual definition of depression. People often assume that since a recession is characterized by 2 quarters of a declining GDP, then a depression, which sounds more severe, must involve 6 quarters of a declining GDP. However, that's not the accurate definition of depression. Depression can be defined as a prolonged period of growth that consistently remains below the anticipated trend, with no clear tendency either to collapse or return to that trend. To illustrate this concept, let's consider the example of the United States, which can be broadly applied to the global context. If the long-term potential growth rate for the United States is around 3 to 3.5%, representing its typical trend growth, then achieving a lower growth rate, such as 2%, creates a gap between the actual growth rate and the potential trend growth of approximately 3 to 3.5%. This disparity signifies a state of depressed growth. In this scenario, while the economy might not be technically in a recession, it is still in a depression because it isn't rebounding to the expected trend growth. This gap, even if it's just a 1 percentage point difference between 2 and 3%, holds significant importance due to the compounding effects over time. The difference between depressed growth and trend growth is termed the output gap or the growth gap. It signifies the extent of economic prosperity that has been foregone due to this state of subdued growth. By adopting an objective viewpoint and utilizing the mentioned numerical values, it becomes evident that we are currently experiencing a state of depression, and it is projected to persist. Japan. Japan's renowned lost decade, which originated in 1990 and extended to 2000, has now evolved into a third prolonged period of economic stagnation, showing minimal improvement in policy or conditions. This extended phase of sluggish growth, around 2%, continues to persist due to factors such as demographics, technology, productivity, and psychology. Similar trends are evident in Europe, with China's case standing out due to manipulated statistics. This widespread scenario of subdued growth echoes a common predicament faced by the global economy. Debt. The pace at which debt is increasing surpasses that of economic growth. Now, is debt inherently positive or negative? Well, that depends. Debt can prove advantageous if you possess the means to manage it, if you can promptly repay it and allocate it to productive ventures. It turns detrimental if you're financially unable to manage it. In such cases, it becomes unsustainable, resembling a crutch for genuine growth and inevitably leading to a crash. Thus, you can't assess debt in isolation. You must evaluate it relative to your income and also consider the debt-to-GDP ratio, a significant metric. I spent a lot of time looking at the GDP, which is chugging along without much growth. However, the debt-to-GDP ratio is worsening. It seems like we're heading for a global debt crisis. We're not quite there yet, but it could happen sooner rather than later, says Jim Rickards. There's minimal uncertainty surrounding the Federal Reserve's, Fed, inclination to tighten its policies. In the baseline scenario, the Fed's course of action is quite straightforward. They intend to enact 4 interest rate hikes annually, during March, June, September, and December. However, 3 conditions could prompt the Fed to pause this tightening approach. The pause factors. Potential reasons for the Federal Reserve to halt its actions include disorderly stock market declines, rising unemployment, and uncontrolled disinflation or deflation. Currently, these factors are not in play. Stock markets are stable without sudden drops, job growth remains robust, and inflation is gradually rising, mitigating disinflation risks. Given the absence of these factors that might lead to a pause, the Federal Reserve is likely to continue with interest rate hikes. However, they are faced with the challenge of excessive tightening. In addition to interest rate normalization, they aim to shrink their balance sheet. However, the dilemma arises if the U.S. economy experiences a recession. As I've said, we're in the 10th year of an expansion. You know the old cliche, expansions don't die of old age, is true, but they do end. History shows that it takes about 4 percentage points of cuts, or 400 basis points in other words, for the Fed to pull the economy out of a recession, he said, as he continuously warned us about the impending recession. The truth is, you can't. You can lower them to zero, but once you reach that point, you're essentially trapped at that lower limit. This predicament is known as the zero bound, and there's substantial evidence suggesting that adopting negative interest rates is ineffective. Printing some more money again. Modern monetary theorists would say yes, but I disagree, and I think the Fed disagrees as shown by their actions in trying to reduce the balance sheet. Therefore, Jim Rickards believes that the Federal Reserve's current strategy involves attempting to increase interest rates while concurrently reducing the balance sheet, aiming for a reduction of around $2 trillion or slightly less. This approach is aimed at preparing for the eventuality of a recession. The idea is that once a recession occurs, the Federal Reserve can employ the same playbook as before, lowering interest rates and potentially resorting to quantitative easing, QE, if circumstances require it. The dilemma. Though we didn't observe a substantial amount of inflation, we did witness a significant surge in asset prices, including stocks and real estate, alongside other asset categories. This phenomenon seems to align with basic intuition. When money is injected into the system, asset prices tend to rise. Conversely, when the money supply contracts, asset prices usually decline. In this scenario, the Federal Reserve, Fed, essentially engages in a dual tightening strategy. Alongside their 4 annual rate hikes, the reduction in the balance sheet can be approximated as equivalent to an additional 4 rate hikes each year. They're effectively undergoing a tightening process that might push the economy into a recession. Worth noting is that the Fed has a history of not accurately predicting recessions, and its forecasting track record is quite poor. This impending recession might take them by surprise, and naturally, the stock market is expected to decline. Given these factors, Jim Rickards holds a bearish outlook on economic growth and stock performance. Some might remark that gold hasn't experienced a significant surge, and while that's true, it's slightly surprising it hasn't experienced a more pronounced drop, considering the tightening circumstances we've outlined. All in all, gold's performance has held up reasonably well given the existing conditions. The methodology that Jim Rickards uses. The method he used was to distinguish himself from those employed by Wall Street forecasters. The flaws in Wall Street's methodology are significant. They make yearly forward predictions. For instance, in 2009, they predicted 2010, and so on. This practice is echoed by the IMF and Wall Street analysts, yet their predictions consistently deviate significantly from actual outcomes. Such recurrent inaccuracy over many years undermines their credibility. Historical charts often display these disparities, and economists' projections diverge widely from the actual trends. Research in social science has indicated that economists perform worse than randomly guessing in forecasting, which contrasts with a binary outcome where a monkey, with no knowledge, would be correct half the time due to sheer chance. Economists are wrong more than half the time due to flawed models and a phenomenon termed herding or group behavior, wherein the desire to conform outweighs the willingness to venture out with potentially accurate yet unconventional predictions. This stems from institutional constraints, job security concerns, and other influences. Economists rely on equilibrium models, but capital markets aren't inherently equilibrium systems, rendering these models inadequate. The efficient market hypothesis is another flawed aspect, and stress tests based on past data can't account for unprecedented future scenarios. Prices are assumed to move smoothly, but markets exhibit gap jumps and discontinuities, contradicting the model's assumptions. The actual behavior of markets contradicts the methodologies and models employed, providing a clear explanation for the consistent inaccuracies in economic forecasting. Financial panic. A financial panic introduces a distinct dimension, diverging from the trajectory of a recession or the fluctuations of a business cycle. While they can coincide, they aren't inherently linked. Let's delve into financial panics as a separate entity, emphasizing the perspective of complexity theory. Complexity theory reveals that within a system, the most severe outcome is an exponential function of its scale or, simply put, how large it is. This concept necessitates considering scaling metrics, which encompass various indicators like the total value of derivatives, average daily stock market volume, and outstanding debt. Although this approach is relatively novel, it shows promise. Admittedly, fine-tuning this theory would likely require years of empirical data, yet its fundamental principles are robust and can be applied preliminarily. If you were to significantly increase the system's scale, say by tripling it or witnessing a 10-fold or 50-fold growth, an associated exponential function would come into play. It's common for people to assume that lessons were learned from the 2008 financial crisis and that debt and derivatives have been brought under control. As Jim Rickards said, "No, debt is much higher. Debt to GDP ratios are much worse. Total notional value gross national value derivatives is much higher." Taking into account the numbers and the higher proportion of total banking assets held by the 5 largest American banks compared to 2008, along with other relevant factors, it's rational to posit that the next financial crisis will be exponentially more severe than the previous one. This assertion stems from objective reasoning grounded in complexity theory. There are essentially 2 possible viewpoints to hold. Either one believes that crises will never recur, which seems improbable considering their historical recurrence in 1987, 1994, 1998, 2000, 2007, and 2008, or one acknowledges the inevitability of their occurrence and the heightened severity. The impending crisis shouldn't catch anyone off guard, given its historical pattern of typically arising every several years. While its exact timing is uncertain, it's prudent to recognize its likelihood. The real problem. The underlying issue has persisted without resolution, and the only change is the magnitude of the bailouts, which have grown substantially over time. The answer lies in an institution with the capacity to bail out the central banks themselves, the International Monetary Fund, IMF. The IMF possesses a unique ability as it can generate its currency known as the Special Drawing Right, SDR. While the acronym might evoke different imagery, SDR stands for Special Drawing Right, essentially representing a global form of currency. This entity has its printing capability, essentially equating to world money, and it emerges as the sole source of liquidity in an upcoming crisis. The central banks, if they fail to restore normalcy before the crisis hits, a possibility that appears increasingly likely, will find themselves constrained due to limited leeway to expand their balance sheets. Going beyond a certain threshold would undermine confidence. In this scenario, the solution to the liquidity problem comes from the IMF. This concept sets the stage for a global monetary reset, a significant shift in the monetary landscape that could be described as a monetary apocalypse. Life is already challenging, given the relentless rise in prices, making it difficult to set aside savings for the future. However, at this point, contemplate your desired future lifestyle. Many financial experts are warning us about an impending recession. Failure to prepare for that might result in substantial losses when the recession eventually hits all of us. If you want to learn more about personal finance and generational wealth building strategies, visit our channel and subscribe for more enlightening videos to increase your wealth.